This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. K-State grain economist Dan O'Brien starts today's show with two segments discussing the grain market following last week's USDA reports. Dan begins with an overview of the futures and cash prices. He also mentions how the feed grains market is looking for growers. The grain market conversation with Dan continues as he looks into wheat and soybeans, as well as mentioning a geopolitical event that is taking place. Chip Redmond, K-State meteorologist, wraps up the show with his weather update. While Kansas has seen cooler temperatures, he says people should be ready for hot, dry weather. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Friday show with a grain market update from K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, as we look at the grain markets, what are we seeing after last week's WSDA report?
Well, not lots of strength. That report actually had some information that the market, if it was focused on the usage side and the ending stock side of things, especially in corn, could be responded to quite positively. And we'll talk more about that later. But I think the primary focus of the market continues to be on crop production issues. The crop ratings for the U.S. corn overall are, again, graphically, if we were looking at it, whereas normally we have a seasonal downtrend right now, the national crop ratings of percent good and excellent shooting to the high side still. So I don't doubt that probably is the main factor in play. Again, no major crop risks on the horizon, although you can see from the information on the weather forecast, 6 to 10 day forecast that we see graphically. I think Chip Redmond as talking about at different times here of late that, yeah, there's some hot, dry weather coming in, but again, no major big issues that are driving things. What I have heard climatologists talk about is that we're generally looking at the condition for U.S. corn and soybeans right now as generally good overall, but there's a lot of pockets that are involved in that. So, and one or two crop threats that in terms of crop development that I hear being discussed, but again, none of them front and center yet to change the overall narrative that prices are moving to the low side, or nothing to interrupt that train of thought yet as we look over the next several months heading off into fall. I would say specifically for corn, we've seen the September contract close. Well, yesterday closed at $4.02. Again, that's, you're hanging around $4, going below that sometimes. The December contract at $4.21. It's interesting that the December 25 contract, $4.21 per bushel, $4.21, and the December 26 contract, these futures for the end of this calendar year going off into next year, literally $4.56. So where does the market tend to go on futures when it here of late, when it doesn't really know what's going on in terms of planted acres or whatever? Oh, around $4.50. So that kind of reveals where we're at right now in our thinking. If kind of a normal crop situation is about $4.50, $4.60, well, right now we're at about $4.20. So really showing the ideas of the market as we stand today. November soybeans, $10.26.5. It's interesting that heading off into next summer, you get summer of 26. A year from now, you're looking at August 26 futures at $10.76, $10.77. This year's futures is about $10.21. So again, similarly, futures really showing a leaning, a bias, a narrative towards large crops and lower prices, at least in their view. And of course, with wheat, we're looking at Kansas City hard red winter wheat futures. I say Kansas City because we used to trade there in Kansas City. It's still Kansas hard red winter wheat, but now it's traded with CME, of course. But anyway, closed yesterday at $5.17.5. Been volatile, moving with some up and down movement here of late in that market. But, harvest pressures, et cetera, all in play. There is some information, particularly for hard red, that came out of the most recent set of USDA reports that we'll talk about, that WSDA report on last Friday on the 11th, that was showing strong prospects for U.S. hard red winter wheat exports. So we'll talk about that. But so far, we're harvesting grain right now. Probably the biggest story price-wise in the futures for wheat are the carries. Again, we seem to be set up for a situation where we'll bring in a large harvest, fair amount of that. If it's sold immediately, it'll go into elevators. Elevators are looking at carries right now from the September to the Dees contract of about 7.5 cents per bushel per month. From Dees to March, just a little over 7, just under 7, heading out to May. So it's setting up really more for a storage situation, unless these exports for hard red winter wheat operate in a very strong manner in the coming weeks and months. And so I guess we'll have some competition between storage and maybe export sales, and that'd be welcome for hard red winter wheat growers that perhaps don't sell right now and are looking to store the crop and see what might happen in coming months.
And as you were talking about this, anything jumping out for cash prices?
Yes, I think the hard red winter wheat harvest, first and foremost, stands out. You see the highest prices in the state, and these are the top elevator bids in these regions. There are other elevators nearby that aren't as high as this, but the top bids were in the Hutchinson area, $5.26, Salina area, $5.24, and that's the current cash price. So last half of futures, thereabouts. Other prices much lower. Topeka at $4.97, but then you go out in western Kansas at Colby at $4.48, Garden City at $4.38, Pittsburgh down southeast at $4.55. So generally low there, and I would say also cash corn prices. Top prices in the state, at least that I saw, $4.07 in the Garden City area, $4.17 actually in Pittsburgh. One bid up at $4.17, almost all the other bids below $4, but one flagship bid out there, and just not a lot of worry about what may happen. Again, if we were worried about Kansas corn crop prospects, we'd see different cash price situation, I think. But since we're not at the moment, then we find ourselves with prices in most places below at or below $4.
And last week we talked about pre-report expectations for the WASDE report that was coming out July 11th. And as we're talking about it now, as the report has come out, anything sticking out for feed grains?
Well, the USDA supply-demand balance sheets were adjusted some for corn and for grain sorghum, mainly for corn. And the following from the lower planted acres that we saw at the end of June, as well as that stocks report that showed some changes in usage. You did see for the old crop contract that the USDA scaled back its feed usage numbers by about 75 million. Still 5.675 million, and made some other adjustments. Exports raised 100 million bushels, up to 2.75 billion, record high, tremendous exports. Then following that here, you can see it this week at what we had in the most recent week for July the 10th. Even that number might be slowing down just a little bit, that pace. But it's pretty obvious to me anyway, when you look at what the USDA had done. They looked at the commitments out into the future, again, for the next 6-7 weeks in the marketing year, and saw what countries have said they're going to buy. And that's basically what that number is, 2.75 billion. Put all that together, and we ended up and dropped old crop ending stocks down to levels, as you and I've talked about on these programs in the past, where, in the past, when we've got down to 1.3 billion bushels, we've had $5.50, $6 corn, but not this year. Again, it's the anticipation of that big crop coming, I think, that's keeping the lid on it, keeping a pretty pessimistic view of things. So we're down to 1.34 billion bushels for the marketing year, projected for the marketing year that'll end on August 31st, and of course you bring lower beginning stocks into the equation, and the USDA did adjust acres down a little bit, and so instead of projecting 15.8 billion bushels, now 15.7, and ran that through the balance sheet, made some other adjustments, a little lower feed usage, ethanol unchanged. That's right. By the time we bring all that through, the main changes were the lower beginning stocks and lower production figures, a little bit lower on feed use. And now we're projecting 1.66 billion for that next marketing year. So again, we ag economists, we hang out in the numbers. We look at ending stocks to use. 1.6 billion bushels is not that much, especially when you figure, gosh, a 15.6 billion bushel corn crop when we've only had 1 or 2 ever before. So the key to that balance sheet is strong usage, even with large supplies, and so we'll see where it all goes. So we on the bearish side of interpreting the corn supply demand balance sheet that the WSDA report came out with, basically they're anticipating by far record high corn production, and that is the focus right now of the market. They're also projecting those pretty strong usage. That if we actually have 1.6 billion bushels or 1.5 when we get to December, then we'll look around and say, this is kind of tight in terms of supplies. But right now, again, we're focused on the production side, and we'll see where we're at. There was a change in the couple changes in the grain sorghum supply demand balance sheet. Production based on lower acres, basically down about 25 million, and the export figure projected for the next marketing year down about 25 million. So still very conservative in terms of grain sorghum prices projected for both this old crop marketing year at $4.10, new crop $4. So feed grains, pretty, I guess we'll be polite and say subdued, given what the market's focusing on right now. The underlying issue, though, is, gosh, lots of usage and pretty tight stocks, and we'll see where that takes us at any hint of crop risk or geopolitical issues that affect the feed grain market off in coming months.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but when we come back, we'll once again be joined by Dan as we continue our grain market conversation. You're tuned back into Agriculture Today, and we continue our show and conversation with K-State grain economist Dan O'Brien. Dan, after the WSDA report last week, what are we seeing for the wheat market?
Yeah, from our Kansas perspective, we see that those broad USDA, United States supply-demand balance sheets, and we don't see a lot of hope in them, because they show basically large supplies. Especially this last supply demand balance sheet the USDA came out with, and we're now in the 25-26 market year. That started June 1. The production figures had come out for July 1st. Not a lot of change, just a little bit higher production. But USDA did increase the U.S. export figure overall by 25 million bushels. But when you dig into the details of it and see where those changes came from, most of it came from hard red winter wheat, what we grow. And it was a surprising change to me anyway. So in the last marketing year, up until this report, we were working off of the idea of the U.S. having about 210 million bushels of hard red winter wheat exported, and that's out of the total of about 825 we were looking at. But now in this report, given the recent strong pace of hard red winter wheat movement, that out of the new projection to 850, 275 of the million bushels of those came out of hard red. So that's a year-to-year increase of about 55, 60 million bushels. They even raised last year's figures a bit. And when you look at what's happening on a weekly basis, what happened for the most recent week we've got data on, July 10th, we had 6.6 million bushels of hard red exports, and without something to compare that to, that's just a number. But what we need to meet the USDA's projection now, and that's this new hyped up projection, is about 5.8, 5.9 million. For whatever set of reasons that are out there, and we've got some we could talk about. I think you and I might talk about the Black Sea situation a little bit. You've got strong movement happening right now in hard red winter wheat exports. So that's for the good side. I think when I look at that supply demand balance sheet for hard red winter, again, we do have some projection of feed usage, about 35 million for hard red. And again, we've been watching that in the Garden City area. So we'll see where that goes. The cash price ratios down there, I think, are about 108% of the wheat price versus corn price. So wheat's not really being fed strongly in that area. And not because the wheat prices are great, but the feed grain prices are not. So cheap corn and cheap grain sorghum working against feeding wheat. But so I guess we talked about the situation overall. That's kind of a positive. I would say also that it continues to kind of at least get my attention to look at what's happening in major exporters of wheat here. Two marketing years ago, for the 23-24 marketing year, major exporters overall had about their stocks to use were about 11.6%. And then last year, the 24-25 market year, the one we finished, about 11.3%, now projected down to 10.7%. So we've got a tightening trend happening. So maybe that's probably a fair amount of what's in play. You know, our competitors on the world scene are tighter as we keep going forward. We really watch what's happening in Russia. Here 2 years ago, the Russian stocks to use for exportable wheat, 12.4%. A year ago, in terms of marketing years, they were at 12.7. This year, they're down to 11 even. So they're tightening up. There's a headline that the USDA, Foreign Ag Service, came out with for wheat. They're basically it indicated that for Russian wheat, we had lower spring crop area but higher wheat crop yield. So that the drought you and I have been talking about for the last several weeks, it happened, but it hasn't taken the yield down some. It just took acres out. So it wasn't damaged terribly, doing pretty good, but they've got some areas damaged terribly, and some issues in play also in the Ukraine. They've had dry weather or had weather problems in growing their crops and looking at issues. So that, and if our colleague Guy Allen was here with us talking about this, he'd want to bring in the currency issues. U.S. dollar's been a little bit cheaper. You add all those together, and hard red, what we grow here, is starting to look a little bit more positive, and it couldn't happen at a better time. Basically, again, wheat harvest, we have good quantities of decent wheat around, and all that adds up to a situation where even though the prices aren't well, underlying demand is not doing that bad, and we'll see if that helps us move our way out of this low price situation in coming months.
And you've mentioned Russia and the Black Sea region and Ukraine. What's happening with that?
No less geopolitical conflict, but so far we've taken our hands off the shipping side, and nobody wants to reignite that conflict and get all these other groups involved. That's a stark contrast about 2-3 years ago when that conflict started up, and the whole world agribusiness food complex, UN, from all these, and the EU and others all got involved, wanted to make sure that grain, especially wheat, kept coming out of the Black Sea region. And unless it's happening and we're not hearing about it, it seems that what grain is grown there is still flowing out. And at least right now in the wheat market, that's not the driving concern that's affecting our supply-demand perspectives.
And our last crop to talk about for today, soybeans. Dan, what did we see?
Well, on the domestic side, the headline that came out here on after the report and USDA ERS oil crops outlook was that the 2025-26 U.S. soybean crush forecast increases on higher soybean oil use for biofuels. And we've had a lot of discussion about new bioenergy renewable fuel standard rules in the last that you and I had in the last several weeks, and so the USDA took that to heart and looked at the new RFS standards for biodiesel, renewable diesel, and made that actionable in the supply-demand balance sheet. They raised soybean projected crush for the new crop marketing year by $50 million, from $2.49 billion up to $2.5, and what they added to the crush, which is, again, get meal and you get oil, and they use the oil for biofuels. They took out of soybeans, so the soybean number dropped 70. The crush number for this next marketing year, again, starting September 1, raised by 50. All in all, you ended up with small changes on the production side. That ending stocks went up marginally. It was just under 300 million. Now it's just over 300 million. Price weakened. 10.25 down to 10.10. That's projected price for this marketing year. I think you stand back and when we look at what the USDA's thoughts are, they see continued large exports out of Brazil coming in and competing strongly against U.S. Soybean exports and some of the. So you've got situation where apparently the window that we had for U.S. soybean exports, where we kept up pretty well, starting to close because, again, the soybean crop out of South America, particularly Brazil, on the world stage. So we're down now to about 10.2 million bushels was the latest figure that we had coming out of on July the 10th from the USDA Ag Marketing Service for exports. And we need a pace of about 22.5 million bushels a week to stay with what the USDA wants. So you look at numbers like that, and it really shows that we're starting to get to compete more directly with Brazil on the world export market. It's hurting our prices, et cetera. I would say also that the underlying strength that was really driving things with soybean oil exports, even that slowed down quite a bit. And you and I would talk about, oh gosh, almost record high soybean oil exports over the last 3 or 4 or 5 months on a per week basis, and now we're back down to just pretty small levels. 4,500 metric tons shipped. We were at 45 to 60,000 metric tons in past weeks. So that's slowed down some. Still not decent, not too bad as soybean meal exports. So I guess on the soybean side, you bring all that together, and it does seem that when I look at this oilseed complex, particularly soybeans, compare that to corn, compare that to wheat, it looks like we'd be more at risk. Ironically, with corn prices being generally low, it looks to me like we're more at risk to any shock on the production side that would impact the corn market that could come in still this summer. I know that sounds like an economist just trying to run the market up. I'm not, but we still have underlying risk there. Still very reliant on large crop assumption, which likely to happen, but not assured. More risk of a volatility to the upside in the feed grains, I think, than we are in the soybeans, just because, gosh, we got these foreign supplies of beans out of South America just coming in and starting to flood the market. And for wheat, well, I guess lower production in any of our major competitors, especially the Black Sea region, still an issue at play. Lower dollar helps. And I guess as long as we still maintain a healthy pace of exports of wheat out of the U.S., particularly for hard red. It'll even though right up front we're kind of overwhelmed with supplies right now in Kansas for wheat because the harvest just happened. Still, a good pace of exports that challenges the profitability of storage. At the local agribusiness sector might help us in the next 3, 4, 5 months, and we'll see where we're at. But by the time we move out into through July and August into September, October, we'll have more surety of the size of the corn and soybean crops and a better idea of what our post-harvest situation is for wheat and see where markets may go from there.
Dan, I appreciate you taking the time to join us today.
Thank you very much, Shelby. I appreciate it.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but we'll be right back. You're tuned back into Agriculture Today. I'm Chevy Lynn Vasky, in for Shelby Varner, and we conclude our show with a weather update from K-State meteorologist Chip Redmond. Chip, thanks for joining us today.
Yeah, thanks for having me.
Chip, how have temperatures been this past week compared to usual?
This week's been kind of interesting. It's felt really, really warm. And when we look at the overall averages for the state, though, we have to consider the fact that things really dried out over the last week. We had some precipitation in southwest Kansas where we got multiple inches of rain in portions of southwest Kansas. But that was early part of the weekend, and then since then things dried out. We had a much drier air mass in place. And when we have a drier air mass in place, our temperatures can swing pretty rapidly. And what we saw temperatures get really warm, 97 degrees, close to 100 degrees. But at night, they were able to cool off still. We were getting down into the 60s, even low 60s in some places, which is much below normal. This is the warmest period of the year for Kansas. The average highs across the state range anywhere from the mid to low 90s for high temperatures and the low 70s to upper 60s for the low temperatures at night. And so we were getting almost 5, 6, 7 degrees below average at night. But in the daytime, we were getting only a degree or two above average for the afternoon high. So as a result, temperatures were actually slightly below average. And we did have quite the rain event that occurred across most of the state, most of the central and eastern part of the state overnight. Wednesday into Thursday morning. And that was a big moisture maker for a lot of folks that really needed it. And you got some much-needed moisture out of this rain event. It was all on a cold front. It just kind of slowly sagged south and east across the state over about a 12-hour period. And that brought as much rain as 10 inches in the Kansas City area. It's going from one extreme to the other. That's a little too much rain. You saw some flash flooding, had water rescues, unfortunately, in that area. But pretty much a widespread 1 inch to a half inch of rain. As a result of that dry weather, we had actually seen drought increase this week. In mostly northern Kansas. Keep in mind the precipitation cutoff for the drought monitor that gets updated on Thursday morning is actually Tuesday morning. So any rainfall that falls after Tuesday morning doesn't get considered in this week's drought monitor. But the drought monitor saw drought expansion. We saw severe drought added to north central Kansas and the Clay County area. And we saw abnormally dry conditions expand, ironically, along I-70 into the Kansas City area. But some much-needed rainfall and a much cooler day on Thursday, with temperatures struggling to even get out of the mid-70s, and that's significantly below average. That was the cool part that we really, really need to enjoy.
Chip, what's the forecast looking like?
We have to enjoy this cool weather because it's gone as of Friday afternoon. Temperatures are going to rapidly escalate into this weekend. We've got a very dominant high pressure that's going to develop across the southern plains and expand north and eventually eastward. The result of the high pressure is going to be that we get warm. We get very, very warm, and most of the southern plains are going to cook. And we're going to see temperatures likely 100 degrees plus for at least a week, starting probably Sunday time frame and going at least until the following Sunday. And there's even some models to keep that high pressure around. They shift it a little bit farther east, and we'll talk about why that's important here in a minute. But they shift a little bit farther east in the Mississippi River Valley to still keep it under the influence of that into August. And so we're talking a week, maybe even 2 weeks of very, very prolonged heat wave. The good thing is if we shift that high pressure east far enough and models keep kind of trending that eastward like they have been, that might allow a little bit of precipitation to work into the western part of the state and get some cloud cover off some weak monsoonal flow that could keep those temperatures in check a little bit. But unfortunately, that's really the only chance of precipitation across the state for the 2-week period. We are going to have some breezy winds out of the south, and that's also going to help dry things out. So this rainfall was needed. We didn't get this rainfall this week. It's unfortunately going to be set up for a really, really rough start for this prolonged heat wave. And I think by the end of the week, 2 weeks, we're going to potentially be in a bad situation if this high pressure doesn't shift far enough.
Chip, thanks again for joining us today.
Yep, thanks for having me.
That was K-State meteorologist Chip Redmond with the weather update. That's all we have for you today on Agriculture Today, but we'll be back with more for you on Monday.